Hey guys, so in past videos, we've dealt with two different types of expenses or economic events that we've needed to take care of. Those are accruals and prepaids. Accruals begin when you sign up for a service. You don't yet pay, but you get billed later. You're using that service, and we need to allocate that expense and an accrual to basically pay off in the future when the bill comes. Prepaids, on the other hand, is when we sign up for that particular service, we pay in advance, and in exchange for that cash, we get the asset, and we allocate the amount that we use over the time, primarily from the time that we buy the prepaid asset until the end of the accounting or reporting period, which would be month end, which we've been using in these videos. And then we allocate the remainder after from month end until the next payment date. And those two different types of transactions have been dealt with in other videos in this channel. Now we get into a very specific case where there's an economic event that triggers both the accrual process and the prepaid. So in other words, we've prepaid for something, and in our examples, we're going to use insurance, but then there's an economic event that happens that combines both prepaid and accruals. They are rare, but you need to know how to account for them. Otherwise, your financial reporting at month end or year end will be off. So let's get into it. All right, so you're reviewing your finances and you see the following. You paid for insurance earlier this month. Everything looked clean, fully handled, but then you upgraded your coverage halfway through the month. And now things don't line up anymore because you already paid for part of the month. You're using more coverage now from the time of that upgrade, and you won't be billed for the increase until later. So now the question becomes, what exactly belongs in this month? Because it's no longer just a prepaid, and it's not just accrued either. It's both. So up to now, we've treated things separately. Prepaids paid before use, and accrued used before payment. But this scenario breaks that structure because one change creates two timing effects at once. If you try to force this into one category, you'll get it wrong. So instead of asking what type of transaction is this, you ask what portion was already paid, what portion has been used, and what portion hasn't been paid yet. That's the entire system. You're not labeling the transaction, you're breaking it apart across time. So let's walk through it. Let's suppose you paid $100 on June the 1st for basic insurance. This covers the period from June the 1st to June the 30th. So initially, it's fully prepaid. You debit prepaid insurance as an asset and you credit cash. Now on June the 15th, you upgrade your policy. The new equivalent monthly cost is $160. But you won't be billed the increase until July. So from June the 15th to June the 30th, you're using coverage that's worth $160 per month, but you've only paid $100 per month. So let's split this correctly. Step one, what was already paid? Well, you prepaid $100 for the full month, so part of June is already covered. Step two, what was actually used? From June the 15th onward, you used higher coverage. That extra portion, the difference between $160 and $100, is $60 per month difference. Now you prorate it, which is half a month or approximately $30. Step three, what hasn't been paid? That $30 difference has been used in June, but won't be paid until July. That is the definition of an accrued expense. So now we record what actually happened. Firstly, recognize the expense from the prepaid. We debit our insurance expense for 100 and we credit prepaid insurance for 100. That takes care of that original prepaid insurance asset that we purchased at the beginning of the month. Next, we record the accrued portion and we debit our insurance expense for the $30 and we credit the accrued insurance payable for the same $30. This is to account for the fact that we had the expense, we used that extra $30 throughout the second half of the month, and we have not yet paid it. So that's why we have the accrued insurance payable. Now your June reflects $130 total insurance expense, even though you only paid $100 so far. So in July, when you get billed, that $30 is no longer new expense. It's just settling what you already recorded. So you remove the accrual and then handle July separately. So this is the key idea. The policy changed on June the 15th, not when the bill arrived. Accounting follows the economic reality, not the billing system. So if you ignore this, June is understated, July is overstated, and your system breaks. But when you handle both prepaid and accrual together, you get a clean, accurate timeline of reality. So up to this point, you've built something most people never do. You can now handle prepaid expenses where you pay for your asset in advance of using it, accrued expenses where you use something before you make payment, and even this mixed timing scenario in the same transaction. But there's still a problem. Everything we've done so far has been based on estimates. Because in the real world, utility bills aren't exact at month end, interest doesn't match perfectly, and actual accounts show up later. So the question becomes, what happens when reality shows up and it doesn't match your estimate, which is based on imperfect models? That's what the next module is about. Reconciliation, moving from estimate to reality and precision. Because building the system is step one, and that's what we dealt with in season one. Making it match reality, that's where it becomes even more powerful.